Well, welcome everyone. This afternoon is the McAllen Society Power Hour. My name is Susan Damiani. I am Director of Gift Planning and the McAllen Society. If you don't know who the McAllen Society people are, they are our legacy members. They've included St. John's in their estate plans. It's a wonderful society to be part of. I know we have some of our members here with us today. Thank you. Hello, everyone. I have my trusted student associate, Luke Nordstrom. He is a freshman here at St. John's. Hello, Luke. He will be our technical
Hello, everybody.
coordinator for today,
Yes.
making sure everything runs smoothly. And then
hmm
I'm sure if you've been on our Power Hours before, you've met John Ceparano. He is founder, partner of Madeira Wealth Management, located in Florida. But if you are looking for a financial advisor, don't be scared that he's in Florida. He does make his way all over. He's obviously an alumnus of St. John's, so he's from the New York area, knows it very well. And I always like to share that he was the cheerleader for the men's basketball team. That is his claim to fame. But he also graduated from the business school at the time was College of Business Administration, and he is a CPA and an expert in financial management. So, like I said to some of you, if you haven't joined us, it's a real treat. And I think it's really great that we do have a smaller audience today because we all know today is the deadline for taxes. Believe it or not, I got mine in just yesterday. I made it. I didn't need an extension, even though my accountant's so good. He made an extension for me. But there's always, questions that come up after you've gone through the process and kind of reviewed your finances. John will share some of that with you, but also to tell you that there is, as he has right here on his slide, tax savvy charitable giving. There's ways that you can give to charities that could really help your whole portfolio. So I'm going to turn it over to John. Thank you, John, for always being a great supporter to the Power Hour series. We appreciate it. And it's great to see you again.
Thanks, Susan. Appreciate the opportunity to help the alumnus with various things that change and progress over time. Today, over the last year, we've probably given about 3 or 4 presentations, and depending on what's going on in the marketplace and what's going on with taxes, which I feel should always be integrated in your planning so that you're not making the government a bigger charity than you need to, getting the dollars where you want it to go, to whether it's St. John's, your church, or wherever, and be able to do it in a tax efficient manner so that you're able to keep more of your money and get it to the places you want it to do without unduly paying more than your fair share. So we're going to go over a couple of things that relate to the Secure Act changes. There was a Secure Act that came out in 2019. And today we're going to talk about an update to that came out on December 29th of last year that changed some of the options that you have, and it created some opportunities. So I'm going to build on a previous presentation that I had with 1 or 2 or 3 slides to get you back into, if you've seen this before, the foundation of giving. So there's different types of ways that you can give, and I'm going to focus on where you are in the stage of your life on this presentation and how tax law changes give you certain opportunities during certain periods of life and stages of your life based on how much you want to give and how much you give annually or in the future. So we'll just get going. So the first one here is an overview. When you're considering your charitable goals, there are pretty much 4 things to take into consideration. One is the control that you want to have over that giving now and in the future. 2, the cost of getting it to the charity. We'll go over that. The tax efficiency, which ways you can get the most to the charity while reducing your taxes. And then the last is the extra steps you have to do, either simple or complex, in maintaining that control. So these are the 4 things to take into consideration. that, whether you know it or not, are factors, and it may impact how and when you give. So I just want to kind of give you the big picture here. The next thing here is we'll talk about some various ways, and then I'm going to give you a summary. Sometimes people want to set things up so that they want to give money when they pass away. So that's when the amount of money could go into a charitable remainder trust. It is literally money that goes into a trust. It comes out of your estate, and it permanently reduces your estate taxes. So right now, the estate tax exemption amount when you pass away is over $12 million. If they don't change the tax laws, that will get reverted back down to what it was previously, down to close to $5 million plus inflation, which may be somewhere around $6 million. That's still a substantial amount, but some people will be hitting that area, and that will go back into effect unless they change tax laws again in 2026. It's just a few years away. So what people are doing, they're charitably inclined and they want to get this out of their estate, is they'll put money into a trust. And during their lifetime, because they may need the income from it, the interest or the dividends, while they're alive, they will get the interest and dividends. And then upon their death, it goes to the charity. So that's what's called a charitable remainder trust. Charitable lead trust is another type of trust. It says that you don't want to give it to charity in the end. You want to give them payments now. So what happens then is that it goes back to the donor upon your death, or goes back to your designated beneficiaries. So this is flipped. This is giving money to the charities while you're alive. And on both of these, you get a charitable benefit, a deduction potentially, depending on how much you put in. And I typically don't recommend that people set these things up unless they're going to be sizable, because there's cost to maintaining these things. There's the cost. Remember, we were talking about some of those elements. There's the cost and there's the complexity. These are a little bit more involved. Then there's qualified charitable distributions. Now, qualified charitable distributions are when you get to a certain age. Right now, that age is 70 and a half years old. Do not ask me where they came up with this. Somebody who was in Congress at that time probably was around this age and said, oh, this is a good age to make it, and they made it that. Because nobody would come up with a cockamamie number like that, but they did. So what they decided is that you spent your lifetime putting money away, probably into retirement accounts. If you were a non-profit, you put into 403Bs. If you were in a profit organization, they may have had a 401k. If you were self-employed, you may have had a 401k plan, or you just put enough money away every year, the $5,000, $6,000, $7,000 into an individual retirement account, an IRA. So when that money went in there, you got a tax benefit, which means that it has not been taxed yet. So what the IRS was able to do was come up with a qualified charitable distribution. When you hit 70 and a half years old, you're able to start taking money out of your IRAs and send it directly to charities. And by doing so, it reduces the amount of money in your IRA. And that means when it comes out, if it goes directly to them, you will not have to pay any taxes. Well, you're able to do that up to $100,000 a year. The new Law Secure Act said that when you hit 73, you have to start taking money out of your IRA and start paying. So at 73, let's just say that you had $1 million in your IRA and your QCD was somewhere around $30,000, $35,000, or $40,000. If you were charitably inclined and wanted to give $10,000 of that away, some portion of it, that $10,000 would not be taxed. So normally, if you didn't give that money away, or you got the money out of your IRA, the required minimum distribution, and wrote checks, now you got to hope that you can itemize with your other types of itemized deductions, such as medical, mortgage interest, if you still have any, real estate taxes, or maybe some other form of charities you give away, like non-cash charitable contributions. But if you can't add those up and get the deduction, you giving this money away after you take it out of an IRA would be non-tax beneficial. By having the checks go directly from your IRA, which you would instruct your custodian to do, or your financial advisor, like in my firm, we will make sure that those checks go out to the charities of your choice in that year. That amount then would be reducing your required minimum distribution and therefore saving you dollar for dollar on the taxes you otherwise would have to pay on it. So it counts towards satisfying your required minimum distribution. These are just some foundational things. So we talked about charitable remainder trusts, charitable lead trusts, and qualified charitable distributions. These are three different ways that you can get money to charities. The next one here is a donor advised fund. Well, if you can only do qualified charitable distributions at 70 and a half or older, what can you do beforehand? You can either just give pure checks away, or you could, if they're smaller amounts, and we'll go over that, or you can give away, put money into a donor advised fund. Typically, people putting money into a donor advised fund typically have a very big tax year. They either sold the business, they got a large lump sum amount, they hit the lottery, whatever it is. In that particular year, they want to have big deductions. So what I typically advise people is that to set up a donor advised fund, what it is money goes into here. You're able to take the money you put into this and put it onto your Schedule A as an itemized deduction. And you'd want to do a sizable enough amount so that you get a tax benefit, which would be above your standard deduction. So if you're a single person, for example, and I've got a little cheat sheet here in front of me, in this year, and you're over 65, that would mean that you get a standard deduction for $14,700. So you wouldn't set up a donor advised fund. You just write checks up to that amount if that's all you were going to give, and not get any tax benefit, because up to $14,700, you're not going to get any more benefit unless you go over that amount. So typically what I tell people in donor advised funds is that they probably need to put at least 2, 3, 4, or 5 years worth of charitable giving into 1 year. Now, what's interesting is this. Once you put money into a donor advised fund, currently under tax law, that money can sit there virtually forever. But the purpose of it is to give that money away once it's in there and you got your tax benefit in the year you put it in there, is to give to the charities along the way. Some this year, some next year, some the year after, depending until you run out. So you make an irrevocable charitable contribution to a donor advised fund, and you get a charitable deduction in that year, and then you recommend grants over time. So you get the benefit in the year you put it in, and the charities get it when you want them to. So you can spread it out. You don't have to give it all at one time. So donor advised funds are before you're 70 and a half if you have large dollar amounts you want to give away. And those can be set up very easily. They're not that expensive to set up, and they charge a fee to manage the funds in it, typically about 0.5%. So it's not a large amount, but it is something to consider, but it works very well when you have a big tax year. So let's start talk about this in stages of life. So this is going to be like a building case for you to understand what you should do, when you should do it, based on how much you want to give away. So let's make believe some of you are still working or under 65 on this call right now. And you maybe still have health insurance, which is subsidized by your company or by yourself individually. So that's your frame of reference. You're still working, and either your company's helping you out with some things and some benefits or not. So your tax bracket, you can see in the second column here, is that you're in probably the highest tax bracket of your life in your last 5 or 10 years of work. So what are your charitable giving options? Well, you can write a check out or use a credit card. You can give away highly appreciated stock. Maybe you were working for a company for a long period of time, or you inherited something like my wife did. She inherited money from her father, which was in the baby bells. And it was from 40 and 50 years ago, and it had a high stock appreciation. Maybe you can give away money like we just talked about in a donor advised fund to a donor advised fund. Maybe you can have a charitable remainder or lead annuity trust. Susan's familiar with all of these. or you could set up a private foundation. So when you give this, put this, this is the way you have to give away this money. How do you deduct it? You got to try to itemize it. Well, you got to get over the hurdles of itemizing. So like I said, a single person in 2023 is $13,850 because you're under 65. And a married filing joint person is $27,700. So for you to get any kind of tax benefit, the contributions that we're talking about here, combined with your other deductions like real estate taxes, possibly mortgage interest, medically, hopefully you don't have any. That means you were sick or had high expenses there. You'd have to get over these hurdles of the standard deduction to get the benefit. So when would you give away checks? When would you use these options? You give away checks or credit cards when the amount you're going to give is maybe under a couple of $1,000s and you're not going to be able to itemize. And therefore, it'd be easy to just write some checks. Can't tell you how many times the kids come up to the door and my wife buys the Girl Scout cookies and they sit in our freezer because she's telling me how she's always on a diet. And then I want to be eating them. Thank you very much, Marianne. Anyway, so that's about giving away money with checks, smaller items. If you have a large accumulation in a particular stock, okay, or a highly appreciated mutual fund even, you probably could give that away to a charitable organization. Why would you do that? That's to reduce your risk. Let's make believe that you gave away 30 years ago, you worked for Kodak, okay? And what do we know about Kodak? It's out of business, basically. So if you had all of your concentration in one particular stock or something like that, you could take the chance of all your resources being lost due to a bankruptcy or something happening in a particular company, bad mistake that they make. So that's a way to reduce it. So if you have a highly concentrated stock, appreciated stock, you could give that stock away. Now, the beauty is when the charity gets it, they will sell it and use that cash. So, and the benefit to the charity is they don't have to pay any capital gains on it where you would. So instead of selling the stock, paying the tax, and then giving the cash away, you give them the appreciated stock for the fair market value, and you get the full charitable benefit when you go to itemize there, potentially benefiting you. Donor advised fund, when would you use that? You'd use this in a high tax dollar year, like I told you, or you bunch your benefits. You're bunching your benefits over a couple of years in 1 year. So what I try to tell people is if you can't otherwise itemize, instead of trying to give away, $5,000 and $10,000 away per year, maybe you bunch 2 years worth in 1 year. And then it may make sense for you because at least every other year you'll get some kind of tax benefit because you'll be able to itemize and get more of a tax benefit than if you just keep taking a standard deduction. The next way, the charitable remainder or elite trust, when would you use that? Like I said a little bit earlier, that's when you have larger dollar amounts you want to put in here, probably somewhere around $40,000, $50,000, $60,000 or more to reduce income or estate taxes. Both. The next one is a private foundation. We're not going to get into too much details, but this is when people really want to control things. It's a sense of control on who they give to and when. In a charitable remainder trust, you can do that as well. In a donor advised fund, you can give them recommendations, but they're able to make some differences in who they can give to depending on how they're trying to spread it out. But they usually follow the rules. But the people who put money into private foundations of very large dollar amounts, sometimes millions of dollars, and they set these up so they can control exactly where it goes. So let's talk about some other factors. When and how much you give away is going to be dictated in many cases by your health and your age and your resources. So those get factored in and when you give and where you give. Everybody that comes in to work with me and anybody in our firm, we have offices from Boston to Florida. It's agnostic to geography. People's circumstances are dictated by their unique circumstances, regardless of where they live. But health and age has a major factor, and it makes people reflect. The other one is other factors is if there's like a sale of a business. on which type of ones we use. We went over that a little bit early. You want to give larger dollar amounts away. So you may use a dollar advised fund here if you're under, 65. Or you have a large capital gain to diversify your risk, or you hit the lottery. So these circumstances are for when people are under age 65. Okay, let's look at the next one. This is from people, and I'm only going to focus on the things that changed that are in kind of like this tannish box here, so we don't have to go over the same things to make this easy. Now let's talk about people from 65 to 70 years old. Why is there a distinction here? Every time I talk to you about an age group, there's a tax implication, okay? So when you were working up until age 65, you were probably in your highest tax bracket. As soon as you go from 65 to 70, retired, you're probably in a lower not working tax bracket. Now, some of you may still be working between 65 and 70, and then you'd kind of maybe fall back into the previous slide. But for the ones that maybe fall into this camp, they'll be in a lower tax bracket. Why? Because they don't have their high wages. They're not making 50, 60, 100,000, 200, or $1,000 or more. So what are you left with in retirement? Most people, they're left with interest, dividends, some capital gains, pensions, maybe if they're, if they were working for a company, and then they have Social Security if they choose to take it before age 70, because you can take it anywhere from 62 to 70 years old. That will impact your taxes. So having the same charitable giving options, where they can get the benefit is if they itemize. When to use those options are all the same. But let's look at some other factors now during these ages. So when you stop working, you're still going to need to spend money, and it's got to come from somewhere. So the question is where is it going to come from? Do you take Social Security early? Do you have a rental property maybe you have? Do you have a pension? Is it going to come from your investments? Those are all your choices, and everybody's situation is unique. Again, health and age will make a difference here. When to take Social Security, just like I said. If you don't have enough in investments and you need to take Social Security early during this period of time, that'll be part of your source of income. What happens if you are bored and you don't love golf, you don't like other activities, and you just enjoy work? You can get out of the house either for financial reasons or for sanity reasons, depending on your spouse. I don't know, kidding. Anyway, so I just want to see if Susan was paying attention and laughing there. Anyway, so part-time work option is something that people consider. One, because they want to keep themselves stimulated. Two, they may be part-time, make some extra money so they don't have to dip into their investments. And three, it's to keep them, involved in their communities and things like that, or continue to use their talents. The other one is long-term benefit of Roth conversions. We didn't talk about this. If you have money built up in these IRAs during the ages of 62 or 65 to 70, whenever you retire, until you're required to start taking your required minimum distributions, or before you take Social Security, which will all show up on your tax return, you should at least consider possibly converting money from your IRAs into Roth IRAs, because then for the rest of your life, it will grow tax-free. So people go, well, why would I want to pay money early in taxes before I actually have to? Because if you wait until you're 70, and everybody's situation is going to be unique, you will have to start taking Social Security at that age. And now with the new law, January 1st of this year, you have to start taking required minimum distributions by 73. So by the time you get 73, above your interest, your dividends, your capital gains, and possibly a pension, you will now have to add on Social Security, and you'll have to add on your RMD. But in between the time you have retired and you have to take Social Security and you have to take your RMDs, you're probably going to be in one of the lowest brackets you may be in for the rest of your life. And if you wait, you may not be able to do it because you may be forced into a higher tax bracket when Social Security kicks in, and also your required minimum distributions at 73. So if you're during this time period and could take some of these IRAs out of the IRAs and put them into Roth IRAs, you can keep yourself from getting into a higher tax bracket when these other sources of income start hitting your tax return. And that will save you money over a long period of time. How do you know how to do this and calculate it? We run tax projections to see where we are. We work with the CPAs. I'm a CPA myself, so intuitively I have an idea of, based on facts and circumstances, when this may work, but it's a unique circumstance depending on the individual people when we sit down and go over these things. It's not just about how much money you make, it's about how much you're going to be able to keep, okay? So the 65 to 70. Let's talk about from age 70 and a half to age 73. If you remember from one of the previous slides, at 70 and a half, you're able to start taking qualified charitable distributions and using the money in your IRAs to send it to them directly to reduce your IRA. And by the time you get to 73, like we were just talking about, you do not have to take your required minimum distribution. So you still have a window here of 2.5 years. So potentially you're going to be in a higher tax bracket if you're taking Social Security, but it would be offset if you did some of these QCDs. So this is a good time to do these, assuming everybody on this phone call is charitably inclined. This is where you would take it out from. Whether you're giving out, $100 a month to the church, whether you're giving $5,000 a year to St. John's, or whatever it is, this is the place to take it out of the IRA, because you're taking it out of an account that's never been taxed, and the money that you take out that goes directly to the charities will never be taxed because it's going to go direct to them tax-free. So you have the same 5 options, to giving money away, plus now QCDs during this age bracket. You can itemize and or do your qualified charitable distribution from IRAs. And it's always best to do your QCDs first, qualified charitable distributions. Why? Because when you start taking your IRAs later, okay, it's going to be based on what the value of your IRA is. That's the required minimum distribution. It's based on the last day of the year. So the year following the last day of the year is what dictates how much your required minimum distribution is. If you start at age 70 and a half before you have to at 73, then your required minimum distribution will come down. So this is a unique opportunity for that 2.5 years to take some money out that you otherwise were going to give anyway to charities and reduce your future RMDs. So you have the same 5 options plus the QCD. Some additional facts. Your additional income from Social Security that you're going to have, because you have to start taking at 70, because you're beginning at 70. And I would recommend you evaluate the tax benefit of continued Roth conversions that maybe you started at 62 or 65 before you got to 70, and to see if they still make sense before you hit age 73, where you have to take required minimum distributions. And then we finally get to age 73. So now the major tax planning you have, without talking about estate planning, but major tax planning you have here, we talk about this. You're potentially going to be an even higher tax bracket because RMDs begin at age 73. All the other choices are the same. And then the other factor is continue to take QCDs first, because you may not be able to itemize or take standard deductions. So what's the summary of all this? Under age 70 and a half, use a donor advised fund, or just write checks out, basically, or use a credit card. And by the way, just so you know, if you use a credit card before the end of the year, even though you don't pay the bill, it's tax deductible in the year you put it on the charge card. So my wife always laughs at me. She goes, "Why aren't you writing out a check?" I go, "I get an extra 30 days to pay the bill, even if it's charitable." So she laughs at me, and 30 days later, I paid the credit card bill, but I get the deduction for the prior year. So everybody laughs at me with these little nuances, right? Next thing, 70 and a half plus, use qualified charitable distributions up to $100,000 per year. So what did we go through all this? I can always make these slides available while they're going to be on St. John's website. So know your planning options at your various ages. And if your CPA is not paying attention to this because you drop off the stuff in the middle of tax season, they don't have any time, they're not going to get a chance to talk to you about this. If you go to your investment person and they don't understand taxes, they don't know what the tax implications. So charitable planning takes into consideration many factors, which can impact what and when you give, where it comes from, and how much you can save in taxes now and in the future. You need to be working with people that understand the investment side and the tax side, because if there's a disconnect there, you're probably leaving something on the table or missing opportunities. So these are the things that I wanted to pass on today. Does anybody have any questions?
Thank you, John. Appreciate that. Does anyone have any questions related to the different, I would say, vehicles that, financial vehicles that John had mentioned? Or if you have any general questions, you're more than welcome to ask that of him. You can type it in the chat if you'd like, or you can just unmute yourself and you can ask the question live. Anybody? We have a very quiet group today. What happened when your account looked at your taxes? Everybody's getting it.
Oh, could I ask a question?
Sure, go
Of
right
course.
ahead.
I'm still working and I intend to keep working past age 70. So I noticed that all of these categories that you went into said that you were already retired. So you were living off whatever income you had or investments. So how would that differ if I'm still working full time?
Okay. So because I have the power of the mouse, I'm going to go backwards here.
Go back to that age group.
Okay.
Right?
Mhm.
So let's make believe that you're over 70, or you are spring chicken, right?
Yeah,
So
not yet.
all of these options are available to everybody all the time.
Okay.
If you're over 70 and a half, you can also do the qualified charitable distributions. So that's only when you're 70 and a half. And by the way, just so everybody knows, it's on this phone call. When they say 70 and a half, they don't mean in the year you turn 70 and a half. They literally mean you can't do the QCDs until you literally turn on the day 70 and a half. So what I tell everybody, wait for the day after your 70 and a half birthday. So if you were born on January 1st, don't do it on July 1st, the QCD, do it on July 2nd, just to make sure, in case somebody counts the wrong day or something. So it's 70 and a half literally in that year. So for you, you still have all these choices. So let's make believe, are you single or married?
Single.
Okay. So if you're single, okay, and are you over 65?
Yes.
Okay. So in order for you to itemize and get any benefit from charities and anything else you can itemize with, you got to have a total of $14,700 this year. Why? Because the government's already going to give you a standard deduction of $14,700. Okay. So let's make believe that you wanted to give away $10,000 in charitable deductions. If you do you own a home?
No, I rent.
Okay. So if you don't own a home, you don't have any real estate taxes. Maybe you have state taxes, though, that you paid, either in estimated payments from the prior year or for any kind of income taxes.
Yes.
Let's make believe that's $3,000. So if you give away $10,000 to charities, you have $3,000 in real estate taxes, and you don't own a home. The only other way to get deductions is if you give away things like non-cash contributions, like, you give away clothes or furniture or a car or whatever. And you also had medical deductions. If you can't get over that $14,700 because you gave away $10,000 plus the $3,000 in state taxes, then you just take the standard deduction and that's it. You don't have to worry about all these things. Okay. If, however, you're giving away $12,000 or $15,000 away, and your real estate tax, and you did, and you, and you gave some other things away. You cleaned out your house. You gave away a couple of $1,000s worth of stuff when you fill out the forms, and you don't have mortgage interest and you don't have real estate taxes, but you get over the $14,700, then you itemize. Now, if you're giving $10,000 away and you can't itemize because between that and some other things, every single year you keep taking a standard deduction, what you may want to consider is this, is at the end of the year, postpone giving for a whole year your charitable contributions. Then on January 1st, 2nd, 3rd, 4th, 5th, give away the bunch of it or double up what it is that you would have gave the whole prior year into 1 year. So instead of giving $10,000 a year away, Every other year, you're giving $20,000 a year away. And in that year, you can itemize your deductions because you'd be way above the 14.7 and get a tax benefit. So let's make believe you did that and you wound up giving $22,000 away. $20,000 away every year. No other deductions. And the standard deduction, I'm going to round it, is $15,000. I know it's a little bit less. So you get an extra $5,000 deduction. If you're in the 22% bracket, that saves you $1,100. The $5,000 more than you would have got for the standard times the 22% tax bracket. That saves you $1,100. That pays for a long weekend at the vineyard with Susan over the summer or something else. I don't know, go on a short cruise. Was that helpful?
Yes, I would like to get a copy of this, your slideshow,
Yes.
because I
Sure.
wasn't paying as much attention when you went through that because I thought you were focusing on it if you hadn't reached 65. So what you told me now is helpful, but I'd like to
Sure.
have that. Yeah.
This power hour is recorded and the recording will be sent to you as a follow-up after the power hour.
Oh,
So
okay,
you'll
great.
be receiving the information.
All right,
Yes.
great. No, thank you.
Oh, you're welcome. There was someone in the chat that was asking about inherited IRA. If you inherit an IRA, can you still get the same benefits with the QCD?
Yes, you can give money away from out of your QCDs. Excuse me.
I'd like just to
IRAs.
add, since I raise major funds for the university, the QCD has become very, very popular. Very, very, very popular way to give to charities. And I will say, even talking to my mom and, to some of my other relatives that are 70 and a half and older, unfortunately, accountants don't really bring this up unless maybe you mention it. Because I remember many, many years ago, I used to say to my dad, why are you giving to your church through, every month or throughout the year? Why don't you wait at the end, towards the end and take advantage of the QCD? Because then, you don't get hit with the income tax. And I said, mention it to your accountant. And he would forget to mention it to his accountant every year, and the accountant would never bring it up. And I just think it's something that's really beneficial to the person and certainly to the charities. I mean, St. John's, we are so grateful to receive that gift. And we're happy that the gift, helps us, but can help you also. So it's kind of win-win for both. So it's something to think about, especially when you're in 70 and a half. And I don't know if you mentioned, John, about the legacy IRA. That's something that was just added with the new act. So within one taxable year, you can give up to $50,000. But normally, when you roll the IRA money, it's an outright gift. But in this particular year, they changed the law. You can roll up to $50,000, but then you can roll it into a gift annuity, which is another great way to give back to charities if they have a gift annuity program. And that you will be given, quarterly income for life. So I think it's kind of like a double benefit. So it's something to look into and to talk to your advisor about.
Depending on their age, I mean, that's
Right.
good for people that are under 70 and a half, but if they've got a large IRA, they probably just want to do the QCD. It's so
The
much better.
QCD, right.
And use the taxes.
Which they don't really give it. I mean, it was funny when I went at a seminar, they mentioned like the traditional QCD and they called it the special QCD. I don't think there's really any
People
name,
like
but
making
everybody
up
calls it the
names. Yeah.
special.
They
special
like
QCD.
making up names for these things.
Right, exactly. Someone else says, in regard to the QCD, can you do it if you're under 70 and a half from an inherited IRA?
No, that's the age. It has to be at
Right.
70 and a half is when the QCDs
Mhm.
start. And by the way, when you're thinking about, regardless of all these different charitable things, if you were going to put a charity, St. John's or anybody else, as a beneficiary on anything, and you have basically three types of accounts that people typically own. They own a taxable account that's basically not a retirement account, like a brokerage account or bank accounts or anything like that. Or they have a IRA and some people still have 401k plans and 403bs that from non-for-profits that they haven't rolled into an IRA. But let's assume everybody rolls it into some point into an IRA, and then they have Roth IRAs. So the best place to gift money away from first would be an IRA. And the reason is that charities don't pay tax. So if you had a son and a daughter that you wanted to give your inheritance to, whatever it's going to be, but you did want to give money to a charity as part of your overall legacy plan, make sure that you make those the charities the beneficiaries of the IRAs first. Because if your kids were getting, money in a taxable account, it's really good, because on the day you pass away, the way the current law is, it gets stepped up to the current value, fair market value, whatever that investment is. Okay. And if they went to sell it the next day, they pay no tax. So if you had some stocks that had appreciated value of $500,000 over the last 30 years, and now it's worth $1 million in total, on the day you die, the kids get it at $1 million. If they sold it the next day, they have no tax. If they get a Roth, they are going to, the kids I'm talking about, not a spouse, but the kids, they have to take it out within the next 10 years. But while it's still in there past your death, they get another 10 years to let it grow. And then they can take it out. And even then, there's no tax. But if they inherit an IRA, they're required to take it out in the next 10 years and pay tax on 100% of it. So if you're going to give it away, let's cut out the IRS, so to speak, get it to the charity if that was your intention in the first place, and they pay no tax either. So IRAs should go to charities first, unless you don't have any IRAs, and then can take it out of your other items. And then the second thing would be is if you exhaust the IRAs or don't have IRAs, then you want to take it out of your taxable account and give the highest appreciated stock that's in there while you're alive. When you pass, it doesn't matter. So just a couple little tidbits there of things.
No, thanks, John. I'm glad you brought that up, because again, not only are the QCDs popular, but people are leaving their legacies and they are gifting their IRAs to charities. It's becoming more popular, and obviously because of the benefits that you mentioned.
Yeah.
Also with the charitable trust, we do work with a lot of people on that type of gift. The minimum would be $250,000, because you're including your attorney and the charity. But we have received charitable trust where people have gifted their real estate. There was one particular gift which I thought they were very, very smart, is that they were moving down to Florida. We know a lot of people moving down to Florida, and they had a Manhattan apartment, and they didn't want to pay the capital gains. So they gifted the apartment to the university and used that real estate to fund a charitable remainder uni trust, which is a variable rate that they would receive. There's an annuity trust where you would get a fixed rate, but I believe they did variable on that one. And again, another win-win, a great gift for the university, but also it was a terrific gift for the donor.
Yeah, the donor gets the income for life, and the charity gets the value of the estate to reduce their estate taxes for later on when they pass away.
But he avoided a lot of capital gains on that one.
They avoid the capital gains. That's huge.
So that was really smart to do something like that.
Yeah, we've got a number of clients like that. I have a number of clients that I have in the New York metropolitan area and all the way up to Boston and in between. You get referrals of different people once they work with you. So it's not just knowing the federal taxes, which we've been kind of basically focused on here. There are a lot of state taxes that you have to take into consideration as well. For example, many of my clients up in Massachusetts are going to probably try, as soon as they retire, is move to a state like Florida where there's no income tax. And also from an exemption, a state tax standpoint, the exemption is not high at all, where Florida, everything is exempt. So these are all considerations. Some people don't like the heat, they want to stay up north, whatever. But when you're doing your planning, you have to factor all these things in. So that's why your financial planner should be well-versed in estate planning, to coordinate and explain what you're trying to accomplish to your estate planning attorney. Because a lot of times people go to their estate planning attorney, and the estate planning attorney doesn't necessarily always ask all of the questions that a financial planner should, because they're meeting with you much more often. So what we recommend and what we do is we put together a net worth statement for all of our clients. And what that means is, here's all your assets, here's all your liabilities if you have any, and here's what your net worth is. So that when it gets to the estate planning attorney, they know what the types of assets are, where they're held, in what state they're held, in order to set up the estate planning to know how, whether you need a trust, whether you just need a will, who the beneficiaries are going to, how to minimize or avoid estate taxes. Avoiding probate is not always the goal. It would be nice, but it's more about managing probate to minimize the cost. Because if you can get a lot of things passing on to heirs directly, charities and individuals directly, and bypassing going through the court system, it reduces the legal fees as well. Attorneys don't, shouldn't get it, but most attorneys will tell you, either gonna have to pay me money to set up and do all the estate planning now, or it's gonna be 5 or 10 times more if you don't when you go and die, and things are costing you money to probate. So we've worked with a number of alumnus, Susan and I, on these programs, and all of them on the same page as me is plan ahead, bite the bullet, get things situated. Because quite frankly, the reality is if you don't do this planning, it's going to cost you or your heirs more money. Okay, it's going to cost you money. Quite frankly, like when
So true. I'm glad you said that. I
Yeah.
don't need to cut you off, but I'm glad you
No,
said that,
not at all.
because there are 2 cases right now that I'm working on. 2 very generous alumni passed away, and their bequests are a mess.
Oh yeah, it happens
And
a lot.
yeah,
here's
and they
what-
have good intentions of what they were going to give to their heirs and to charities, including St. John's. And now we're not sure, what we're going to get. And on a lot of these that I'm noticing, it's interesting that you brought up, everyone thinks about the federal and they don't think about the state. And we have an advisor that, helps us, guides us through on some of these, especially if they're technical bequests. And he kept on saying, you know what, even the attorneys, some of these attorneys, which I'm sorry to say, sometimes you get a good advisor or you don't get a good advisor. Fortunately, it's one person, very wealthy, did not select a good advisor, selected, a celebrity type of attorney, but not very good, and didn't take in the state aspects, the state taxes involved, and it is going to affect this bequest big time. In fact, one of the heirs is like the one that stepped forward and brought this to the courts because they're all concerned. So, what John is saying is very real, because as a director of gift planning, I see this all the time. That you can't believe, it's like sometimes hard to fathom, especially if people have a lot of money. You would think they would get, the best attorney possible. But how do you know? Sometimes you don't know.
That's a difference.
You know,
It's an interviewing skill.
it is.
Now, the old saying is like this. When there's a class that goes through that's a bunch of doctors and they all graduate, okay? What is the person called that gets the lowest grades in the class of the medical class? Doctor. There's no distinguishment.
Right.
So the smartest person, it should also be combined with experience. That's what's important.
But I think you're right. You need to interview. And also, I agree with another thing that you just said. You really need a team. And that's why I love, we have this seminar that will be coming up in September. I don't have the date yet, otherwise I would share it with you, but it's called Meet the Experts. Yeah. And what I love about this is because we have the CPA, we have the financial advisor, we have the estate attorney, we have the funeral director. I mean, we have everybody there on board. And because everything, all those decisions need to be factored and together as a team, like you said. And what you were saying about the net worth, probably this person didn't have their financial advisor, that probably didn't talk to the estate attorney. So they might have been in the dark because maybe they were just getting the information from the client who probably didn't have the proper information. I really don't know, but it just feels so sad when you see a lot of this go through probate and all of this money is, sorry for the attorneys if they're listening, are wasted on
No,
the
they're
attorneys
doing a job
when it
because
could be
somebody didn't
going to
give
their
them advice.
family
Yeah.
members, you know? So I do see it. Everything you said is right on the money.
Well, here's what's most important. Most individuals, what they wind up doing is they go see their attorney and they hear their advice and they go, okay, I guess that's what we should do. They go to the insurance person with the best of intentions. They take their advice on what they're going to do. Keep in mind, insurance people have to make a living, so they have to sell things. They're not bad. It's the way that the business is. But if they don't know all the facts, you may be overinsured or underinsured for that matter. If you go to the tax person, the only time you see them is in, like February or
Once a
March
year,
when
they're busy.
They don't have time to understand all
Right.
the circumstances or plan ahead.
Exactly.
And then you get the investment person, if that's all they do and they don't understand taxes or all these other planning opportunities, there's always gaps in the planning. Our whole purpose and the ways, and I got into this business because I started out on the tax side and did a lot of consulting, was that I realized that I didn't have all the time during tax season. So we sold our CPA practice about 18 years ago. And I said, I'm not going to lose all the knowledge that I had. So I continue to learn. But what we did in that process over the last 20 years is filling the gaps and working with really bright other professionals in these other areas. So we're kind of like the concierge that goes out and meets with you and coordinates and communicates with all these people. So everybody knows what all the facts are. So when we come up with a comprehensive plan, it's coordinated and communicated. And then you have peace of mind knowing that I may not have understood everything individually, but I didn't understand how one area of planning could impact another so much if you don't understand what the consequences are. And that's what a really good wealth manager should be. I'm really proud to be part of a great team that's how we work. And I wish my parents would have had this, 25 or 30 years ago. And my brother would have had a much bigger inheritance. But anyway, so
does anyone, because we're nearing to the end, but thank you, John, for sharing all of that. Does anyone have any other questions for us for today? Like I said, you will be getting the recording. We'll be sending that out to you. Kitty, no questions? Sorry, put you on the spot. Kitty's always good with questions, though.
And by the way, you can always send an email to us if you want. If you have any,
we'll share your information with everyone. So if you have
share.
any questions, they can email you directly. But I hope this was so helpful to all of you. Thank you for joining us. Remember, last week of April is Alumni Reunion Week, so check out the website. There's lots of fun activities going on campus and off campus. And please, continue to join us for our Power Hour series. We have a great one coming up next month with Professor Chipola, Emeritus, and he will be talking about, does Sicilians have a sense of humor? He's the Italian professor, he should know, and he's Sicilian. So if you'd like to join us, that will be in May. Luke, what date is that? Is it May 9th?
It is May 9th, yes.
Tuesday, May 9th at 1 o'clock. He's great. Everyone really enjoys listening to him. Actually, he taught a Sicilian to Al Pacino for the Godfather movies. That's one of his claim to fame. So if you're not doing anything at 1 o'clock, please join us for that. Thank you again. Have a wonderful afternoon. Always great to see everybody.